Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mish Shedlock, editor of Mish's Global Economic Analysis that you can find on MishTalk.com. Welcome back to the show, Mish.
Hey, a pleasure to be back on, and we've got the word of the day to analyze, and that word is uncertainty. And the second word of the day is hike, and the third word of the day is rate. And the reason why we're discussing this is today the Fed released minutes of its July 26th, 27th FOMC meeting. Scanned the word for the word hike, as in rate hike, and I counted precisely one use of the word hike. But then I went and counted the instances of rate, and there were so many of them I had to go back, pull open the document in Word, and count them. There were 121 instances of the word rate. However, included in that is stuff like generate, moderate, corporate, unemployment rate, when I was really looking for rate hikes. So I narrowed that down, and there were couple key sentences in a paragraph, but to summarize the whole thing is they don't know what the hell they're doing. There were three camps: those that thought there should be a hike now, and those that thought there shouldn't be a hike because they're concerned that inflation isn't high enough. And then there was a third group that was essentially of the category, I don't have any idea, so let's wait and see.
Now, these are the so-called experts that everybody around the world hangs on every word of theirs.
Yeah, they do, and that's the reason why I decided to go through and count up some of these words. The key thing for me was uncertainty. Everything. You can't avoid this word, Jim. Everyone talks about, uncertain. If ever these economists are all certain that something is going to happen in the future, it's a pretty good indication that something else is going to happen, because literally these guys are never right. Meanwhile, even though they only used the word hike one time, the Wall Street Journal concluded the Fed's minutes show a split central bank seeking to keep all options open. CNN Money said Fed officials talk up rate hikes in 2016. I certainly didn't get that out of this. The BBC concluded the Federal Reserve split on the timing of the next rate hike. That's at least accurate. Bloomberg said gold advances as Fed split on whether a hike rate needed soon. Actually, gold was down today. The Market Watch said, probably the most accurate headline of all, the central bank that cried wolf, ? Talk of U.S. higher interest rates is often just that. They've been go back to last December. The expectation for this year was 3 or 4 hikes this year. Guess what? The odds of a hike in September are now something like 12 or 18%. The number varies by the day. But the Fed's not going to hike in September unless there's some miraculously good data between now and the meeting, and I certainly wouldn't count on that. Anyway, it looks like it's roughly 50-50 for December, so maybe that's the new normal here. One rate hike a year. That's if they get it in, though, Jim, and I don't think they will.
Would one rate hike be okay? Would it be bad for the U.S. economy?
Actually, there was one semi-sensible comment in the whole thing, and it pertained to a few of the FOMC participants, a few of the Fed presidents were worried that that this low risk environment might intensify risk taking for investors, yielding to a rise in the misallocation of capital and the mispricing of risk with possible adverse consequences for financial stability. Now, I certainly agree with that, but that's what's already happened. You know, that isn't something that's about to happen here all of a sudden because the Fed doesn't hike. This has already happened. And so the question is, if the stock market starts unwinding, is the Fed going to continue to hike anyway? So these are the forces in play. They've blown this massive bubble, and they're now just thinking, well, we better not just a few of them. We'd better hike, to prevent this bubble from blowing that's already been blown.
Are people being deceived by the numbers the stock markets are putting out right now?
Well, actually, earnings have been going down, and so here we are. The stock market is an all-time high, and earnings forecasts, and the likes have actually been falling. What we have now is the most overvalued market in history, with the exception of, it's now more overvalued than it was in 2007, and the only comparisons are to the dot-com bubble in 2000 and 1929 in terms of how stretched market valuations are here. I'm looking at a GMO forecast here right now, and it's a 7-year asset class real return forecast. So, in other words, this will be the average return every year for 7 years, and the average of the 7-year period. And they're looking here. U.S. large cap stock down 3%. U.S. small equities down 1.8%. U.S. bonds down 2.3%. International bonds hedged down 4%. Now, imagine these kinds of returns if we've got these for 7 years. If the stock market fell on average 3% a year for 7 years, that's the forecast. Now, these are real returns, so that's after inflation. So if you say inflation's going to be 2%, then we're still talking, let's say on stocks, negative 1 or 2% returns a year for 7 years. Now, just imagine, even if stocks just return, 3% a year for the next 7 years, what that's going to do to pension plans that are assuming 7.5%, or 8% a year for the next 7 years, even if they just get 1 or 2 instead of actually losing money over that period. These things are going to be insolvent, and Illinois will be right there at the top of the list.
We'll have more with Mish Shedlock right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Mish Shedlock. Mish, if low interest rates were the solution to everything, then Europe and Japan with negative interest rates should be booming right now, right?
Oh, absolutely, they should be booming. Of course, we have the uncertainty of Brexit, and we have the uncertainty caused by the Syrian refugees, and we got the uncertainty of bombing and terrorism, and the uncertainty of whether or not Donald Trump or Hillary Clinton will win the election, the uncertainty of who's going to win the next election in France. It's all a bunch of nonsense, so they're taking these failed policies of lowering interest rates and then blaming everything that's gone wrong on uncertainties of all kinds. Meanwhile, in Japan, Krugman is calling for more fiscal stimulus, and I did a post on that. And Japan had nothing but fiscal stimulus for 2 decades, and all it did was dig them into a hole. There are small cities, 50, 60,000, that have universities, aquariums, all kinds of things, highways that no one uses, bridges and roads that just like dead end in nowhere, had all this stimulus for decades, and it hasn't bought them enough. And their answer is, we didn't do enough of it, and that's why things aren't working. No, things aren't working because Japan has all of this debt and doesn't know what to do about it.
Well, Japan is a nation of savers traditionally, and we talked about jokingly, I guess, them running out and buying home safes to keep their money because of negative interest rates. Mm-hmm. But they have a term there, they call it closet money, where they hide their cash in closets because after World War II, they learned they couldn't trust the banks.
Yeah. Now, fearing of negative interest rates on banks, there was a run on safes in Japan. People went out, and these things were backward. They ran out of safes. So yeah, there's a lot of fear there. But interestingly, banks in Europe now, in Germany, are talking about, because of the negative interest rate policy there, they're actually talking about, getting cash from the ECB and storing it in bank vaults, rather than paying, interest on that. The problem here is insurance costs. But anyway, it does show that these central banks are running up against the limit. Now, of course, this is the reason why they want to ban cash in the first place. Now, the ECB banned the 500 euro note, so the largest you can get now is 200 euros. So, and in the U.S. it's $100, and I think Geithner or someone was talking about, saying, well, we should get away with a $100 bill and only have 20s, and they're saying this is to prevent fraud. No, this is a drive to eliminate cash, so that people will not have any other alternative other than to hold cash electronically. And then at that point, central banks can do whatever freaking crazy thing they want and charge as much negative interest rate they want, even though that history suggests that it's totally counterproductive. What they're doing when they charge banks interest to keep money on deposit at the ECB is they're actually eating into bank profits, making it less likely they're going to lend, not more likely. And then the whole thing here is interesting. It's all predicated on the notion that by charging negative interest rates, it's going to get these banks to lend their excess reserves. These excess reserves come about precisely because of central bank policy. Technically, it's impossible to loan these excess reserves because the reserves are just going to get redeposited at some other bank, no matter who gets that loan. So mathematically, the whole thing is stupid. It's proven to be counterproductive, yet central banks are talking about doing more of it. Amazing.
Doesn't this just push people more towards things like gold and silver?
I believe that this is, in fact, the reason for the strong rally. in gold, and a huge rally in gold miners and silver miners starting in December or January, depended on miners. But like by mid-January, it was like everything was really starting to take off. Yes, it does explain that, and gold does best when faith in central banks comes into question, and I believe faith in central banks is in question now. Gold fell from 1900 all the way down to oh my gosh, this fell $700-800. Starting when Mario Draghi came out with his announcement that we will do whatever it takes, and trust me, it will be enough. He actually didn't even do anything then, but yields started dropping across the board in Europe. Yields in Spain went from 7-8% or so to negative recently on some of the shorter-term notes. You've got Spain and Italian debt actually trading at interest rates lower than interest rates here in the United States for comparable durations. That's pure madness. This stuff is priced as if it would be impossible for these countries to ever leave the Eurozone, and in fact it's not impossible, and various leaders in Spain and various leaders in Italy, the leading political party in Italy is actually calling for a constitutional question on whether or not Italy should stay in the Eurozone. Yet these yields are trading as if this is impossible and can never happen. In Austria, we've got an anti-immigration president who barely lost an election, but the court decided, well, maybe it was rigged. They had a redo of the election. This guy is leading in almost all of the polls now. I expect him to win. So there's lots of uncertainty, if I can throw the word out there, staring at these guys, calling the shots. Jean-Claude Juncker, the president of the European Commission. These guys don't know what's going to hit them. First we had Brexit, and now we've got these Eurosceptic parties on the rise in France, in Italy, and in Spain. So this is what's behind all of these things here, are what's behind the rise of gold. And in the United States, of course, the Fed keeps promising these rate hikes and doesn't deliver. We're down from 4 rate hikes promised to maybe we'll get one in this year.
Yes, and it's right up there with the check is in the mail.
It's right up there exactly with that.
Mish, thank you so much for chatting with us.
Pleasure to be on, and we'll catch you in a week or two.
My guest has been Mike Mish Shedlock, editor of Mish's Global Economic Trend Analysis on MishTalk.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.